When the stock market crashes, most people panic. They sell everything at losses and sit on cash hoping to avoid disaster. Smart investors do the opposite. They view crashes as clearance sales where the most valuable companies are suddenly available at discount prices. This mindset shift transforms economic crises from catastrophes into the greatest wealth, building opportunities available. During the 2008 financial crisis, while ordinary people were losing homes, Warren Buffett publicly announced he was buying American stocks, famously stating that his simple rule was to be fearful when others are greedy and be greedy when others are fearful. That decision made him billions of dollars. Today, you'll discover exactly how smart investors exploit economic crises and the specific strategies that turn market crashes into personal fortunes. Understanding the crisis psychology, the first principle is understanding why crises create opportunities. During a crisis or recession, many assets like stocks and real estate can become undervalued because prices drop below their actual worth due to widespread fear and panic selling. This is the crucial distinction. The value of a business doesn't actually change when the market crashes. Coca-Cola didn't become a worse company on September 29, 2008, when the stock market lost $1.2 trillion. The business was identical. But the stock price fell dramatically because emotion, not fundamentals, was driving the market. Smart investors recognize this disconnect. When fear dominates, prices disconnect from reality. That's when opportunity emerges. During recessions, the stock market often goes down, providing an opportunity to buy lower-priced shares in solid companies that may increase in value as the economy improves. This seems obvious until you consider that most people do the exact opposite. Panic selling locks in losses. It guarantees that you'll be buying high during good times and selling low during crashes. Smart investors invert this pattern completely. The cash reserve strategy. The second critical strategy is maintaining cash reserves during good economic times. Investors should build cash reserves to avoid selling investments in a market downturn, and investing more during downturns if you have long-term funds is a powerful strategy. This seems counterintuitive. During good times when assets are expensive, smart investors hold significant cash. During downturns when everyone else is broke, they deploy that cash to buy undervalued assets. Warren Buffett's strategy emphasizes maintaining excess liquidity as one of his chief priorities, ensuring that when opportunities arise during downturns, he has capital available to deploy. This patience creates asymmetric advantage. While everyone else is trapped without capital, constrained to watch opportunities pass by, the investor with cash can deploy it at precisely the moment it's most valuable. Berkshire Hathaway made big investments during the 2008 crisis, backing General Electric and Goldman Sachs when everyone else was avoiding these companies. These investments became extraordinarily profitable precisely because they were made when terror was highest. The selective investment approach. The third strategy is being selective about which assets you acquire during crisis. Low debt, profitability, strong balance sheets, and positive cash flow may all help a company get through difficult economic times. Not every company is a good buy during a crash. Some companies are failing for legitimate reasons and should stay avoided. Smart investors distinguish between companies with structural problems and companies that are simply cheap because of temporary market panic. Buffett warned against investing in highly leveraged entities or businesses in weak competitive positions, but urged readers to see that the downturn provided an opportunity to buy strong companies at low prices. This selectivity is crucial. You're not buying anything cheap. You're buying quality at discounted prices. A company with strong fundamentals, minimal debt, and consistent profitability that drops 50% in value is a bargain. A weak company dropping 80% is still dangerous. Real estate during crisis. The fourth strategy applies specifically to real estate investing. Real estate often becomes undervalued during recession, allowing investors to buy properties at lower prices to potentially make significant gains as property values usually increase over time. The pandemic created a unique situation. Many property owners didn't have the cash to pay their mortgages, which meant opportunity for real estate investors who had capital available to acquire distressed assets. This created a two-phase opportunity according to market experts. First, repricing as assets became undervalued. Second, the recovery phase when those assets appreciated again. REITs that were quick to adapt to changing market scenarios during COVID-19 profited significantly and are expected to continue profiting, while those that didn't adapt suffered losses. The ability to identify which real estate sectors would thrive during crises versus which would suffer separated winners from losers. Industrial real estate and warehousing benefited from e-commerce acceleration. Retail properties suffered. Smart investors analyzed these trends carefully before deploying capital. The dollar cost averaging advantage. The fifth strategy involves consistent, systematic investing through downturns rather than trying to time the absolute bottom. Invest regularly during recessions using dollar cost averaging to minimize risk and enhance returns. And avoid panic selling during market downturns to prevent locking in losses. Most people fail because they try to perfectly time the market bottom. They wait for the absolute lowest point, which never comes. By the time they're confident it's the bottom, recovery has already begun. Smart investors use a different approach. They invest consistently on a schedule, regardless of price. This means buying more shares when prices are low and fewer shares when prices are high. Over time, this approach produces superior returns to trying to time markets perfectly. Even if you had invested at the worst possible moment in 2007 before the financial crisis, you would have achieved a 524% total return in the roughly 18-year period through the end of 2025. This demonstrates that even bad timing beats not investing at all. The sector selection strategy. The sixth strategy involves understanding which sectors perform well during different economic cycles. During recession, there are often a handful of sectors that continue to forge ahead and provide investors with steady returns, such as healthcare, utilities, and consumer goods sectors. People still need electricity. They still need medical care. They still need basic groceries. These sectors remain relatively stable during downturns. Dividend-paying stocks can become a financial lifeline for investors when the economy slows down, because you're not just hoping the stock goes up, you're actually getting paid to wait. Smart investors identify which businesses sell necessary products that people buy regardless of economic conditions. These defensive stocks provide both stability and the potential for appreciation when the economy recovers. A utility company paying a 4% dividend while the economy is crashing is far more appealing than a speculative technology stock that might go to zero. The mindset that separates winners. The final principle is psychological. Buffett said that markets occasionally do crazy things, and seizing the opportunities then offered does not require great intelligence, but instead requires an ability to both disregard mob fears or enthusiasms and to focus on a few simple fundamentals. Every crisis tests this principle. When everyone is panicked, when news is terrifying, when friends are losing money, maintaining discipline feels almost impossible. Yet it's precisely in these moments when the greatest opportunities emerge. As long as you keep a level head and approach a crisis from a long-term viewpoint as Buffett does, you should come out of it just fine, if not stronger than you went in. The investor who maintains focus on fundamentals, who recognizes that panicked selling has created mispricing, who has cash available to deploy and patience to wait out uncertainty, will eventually accumulate significant wealth. Not through luck, not through insider information, through disciplined, unemotional investing during periods when everyone else is emotional. The historical pattern: economic crises are inevitable. Markets will crash again. Real estate will experience downturns again. Those who understand that crises create opportunities rather than destroying them will be positioned to profit, while others suffer. If you invested $1,000 in Apple in early August 2008, it would have been worth more than $9,222.50 as of August 2, 2018. That's not because of genius timing. That's because someone was willing to buy during maximum fear. Smart investors treat economic crises the way smart shoppers treat clearance sales. When prices drop dramatically, that's when you buy, not when you sell. That's when you deploy capital, not when you hide from risk. That's when you take action despite fear, not because you're fearless, but because you understand that fear creates the greatest opportunities available.